Hi there, Chuck Gibson from Financial Perspectives in Pleasanton, California. Today on my monthly market recap, I'm going to look at a few noteworthy charts of October market action. So let's get right to it. My first chart is a daily view of the S&P 500. All I can say is, what a difference a month makes. In my last video on the US markets, I talked about the possibility of being in the C leg of an ABC correction and wondering if it was over. I also mentioned that regardless of when it was over, I expect a healthy rally to follow. As it turned out, the end of September was the bottom of that correction, and we bolted immediately higher, ending the month of October more than 11% higher than that September low. October turned out to be the largest monthly dollar move in the Dow Jones Industrials and the fifth best in the S&P 500 since 1928. While I don't believe this rally has ended, I do expect it to slow considerably as it finds more resistance at these levels. If you look to the left in the chart here, you can see a very large accumulation of supply that the bulls will need to work through to push this market higher. Additionally, a move that has come this far, this fast, will need to take a breather as we approach overbought conditions. I continue to stick with the thesis, as discussed last month, of a rally lasting for many weeks or months, likely early into next year. I doubt it's going to be a smooth ride from here, but I do expect new highs to be created for some and maybe all of the indexes. The next chart is a table of monthly seasonality, which shows the historical patterns that have persisted through time. You can see that other than April, the months of November and December are typically the strongest of the year on almost all time periods shown on the chart. My next chart is that of the U.S. Small Cap Index. We watch this index closely, as the small caps tend to be the leaders into market reversals, both bullish and bearish. They act as an early barometer to the overall market direction. As you can see, unlike the S&P 500 chart I showed before, the small caps have yet to break above the B leg high of their ABC correction. This reflects relative weakness as compared to the rest of the market and has our attention. They had a very constructive setup out of the end of the correction as momentum created an oversold divergent low with price, so their performance is disconcerting right now. While I don't want to make too much of it, as they could easily rocket higher and catch up with the broader market here in the next coming weeks, it is definitely something I'm watching closely. On the upside, the bullish tailwind of the small cap January effect is almost at our doorstep. My next chart is of the biotech index, IBB. Over the past 5 years, this has been the leading sector, helping to propel the overall market onto continual new highs. You can see that the September correction created bullish RSI divergence with a capitulatory volume spike, which are two of the hallmark signals I look for before I feel comfortable in saying that a bottom is in. While the movement off the bottom is very constructive, and in spite of the possibility of a bottom, the fact is we still have lower highs and lower lows. And this, by definition, is a bear market, and bear markets are something this investor wants to avoid. So until price can overtake the September high of around 364, this bounce should be viewed as an opportunity to sell any remaining shares you own if price now begins to falter. If, on the other hand, we can move through the 364 level and supported with strong volume, that would be a signal to me that the risk is back on and the resumption of the biotech bull may be in place. The elephant in the room, and what I have both eyes on right now, is the US dollar. As you can see in my next chart, which is a 15-year look back on the dollar, it rose forcefully on the breakout of consolidation last year. It peaked in March at the same time creating a massively overbought condition and has been consolidating ever since, forming a bull flag. We know these flags most of the time are continuation patterns in the direction of the trend prior to consolidation. But there are no guarantees that this will be a bullish upside break, so I continue to watch closely for that breakout with confirmation. When flags and pennants develop, you want to see at least 5 alternating touches to the upper and lower channel lines before they can be considered valid. Any breakout without those prerequisites would be viewed as a false move. The long-term weekly chart does not provide that level of granularity, but my next chart does. This daily look at the US dollar, you can see that not only do we have a confirmed breakout, but the other requisite criteria have also been met. So, if this turns out to not be a fake out and it really is the start of a next leg higher, it's important to have a game plan for what may lay ahead especially when considering the upside target from this flag is back at the prior 2002 highs. This would be a huge move for a currency, and it brings with it some very interesting and even crazy possibilities. Mapping out what could likely occur in general terms would include continued downward pressure on commodities, including precious metals, keeping them off our radar as investment opportunities. In that same light, virtually any non-dollar based investment, such as foreign stocks and bonds, will likely lag behind their equivalent U.S. opportunities due to the exchange rate risk, especially those in the emerging markets. Domestically, it will continue to put pressure on profits from those multinational companies who get a substantial portion of their revenues in foreign markets. So far, it seems like the rising dollar only presents bearish investment signals. Well, maybe not. I want to leave you with this one thought to consider, which is the possibility to overwhelm all the bearish signals I have mentioned so far. If you put yourself in the shoes of a foreign investor, what happens when the dollar rises? It likely means your local currency is falling. And under these conditions, smart investors, regardless of their location, usually move at least some of their investment capital to the areas of strength, wherever that may be. This is how the market works. Money just rotates and it follows strength. So if the dollar continues on its upward trajectory, and depending upon how high it goes, it's possible we see a large amount of foreign investment capital rotating into the U.S. investment markets. I would expect the greater the rise in the dollar, the greater the amount of money flowing in. If the dollar hits my target, I don't want to even tell you where the stock prices might go. And now, back to reality. All of this supposition is interesting and fun, but its only place in investing is as a part of the planning process. Regardless of what happens going forward, we'll continue to follow our process, investing in rising markets and avoiding those that are falling. That's it for this month's video. Have a great November and Thanksgiving holiday if I don't speak to you beforehand. As always, appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with the October Monthly Market Recap.